let's start with a question to you, Alex. There he is. Eugene. Okay. Some incoming questions from let's say from the app. Some have already been answered by Eugene, but we will repeat them anyway. So let's start with Alex. So what do you see as the biggest risks to a sustained recovery in oil prices this year?
It's a good question. I think to recap on what I was just saying, or to follow up on what I was just saying, I think with the kind of the absolute flat price where we are, with the crude prices where we are, the incentives to cheat for many members of OPEC Plus it's just so tempting. I mean, I think that's something that we are at a real risk of seeing. We've already seen it with some of the more kind of flat price responsive players, the likes of Nigeria, Kuwait, like in Iraq is desperate to ship more crude. Those players will be seeing this flat price, and it will be very tempting to just keep on slipping out more barrels. To be honest, even for the Saudis and the stated 1 million barrel a day cut, when we look to see what's happening, whilst we aren't calling directly crude production, we are looking at their exports, we're looking at the refinery activity, and we can kind of proxy that with product exports and so on. We can see the inventory changes, and we just can't see how that 1 million barrel a day cut comes either. And I think people are kind of realizing that by the fact that the crude market is lengthening, spreads are softening. But that's the kind of the discipline to hold for OPEC is one side. Obviously, the demand is the other piece. We're talking a lot about the kind of the growth, the improvement in demand. It's so regionally variant. There's a chart that I didn't put in here, but I always have it in another deck. It's particularly gruesome. The Financial Times has very, very good data on COVID and charting, and their new daily deaths by country per population head is particularly gruesome. But if you plot the US, European Union, and UK against Japan, Australia, and South Korea, you just see this totally diverging picture, and it's improving in Europe. The UK has been a basket case, but we're getting better. What's concerning is that Europe's flatlining now. Europe is not decreasing, and that's a real concern going forwards. What's happening around all the vaccines is just bizarre in Europe. When you see what's happening in the UK and the US, it's puzzling. And that's ultimately it. The demand potential for a demand rebound is very finely balanced, I think.
Okay, well, thank you very much, Alex. Yes, you're right. We want more vaccines in Europe.
Yeah.
If I could add something to that one, just to debate. I mean, one thing I feel is that when you look at the fundamentals, as Alex was saying, I mean, the spreads are coming off, and you've got the whole issue with soft Chinese buying, which is having a big impact on Atlantic Basin and West African programs still available when they should be sold out. Stuff like this is juxtaposed. If you look at that and compare that to where the flat price is, then obviously there's a disconnect there. And so one thing that we've been talking about is that there's this divide between fundamentals and financial in terms of flat price. And so there's just been a tremendous amount of managed money being invested into into oil as a investment vehicle, and that really has pushed the price a lot higher. And I do think we're kind of getting ahead of it as well.
Yeah. Although, if you look at the charts, inventories seem to be balanced, right? So supply and demand seems to be in balance, so prices are, stable.
Yeah.
It depends on Iran. It depends on China.
But I kind of laugh because throughout, as I was saying earlier, throughout my time kind of sat on the trading desk, if I ever had a differing opinion to what the guys at JBC were saying, it would be a case for me to go away and do my homework basically and just say like, okay. I've found that as an analyst, you always have to kind of slightly tone down the traders' exuberance, and I feel that kind of I've always been on a similar wavelength with the guys at JBC, where I think one thing we didn't touch on here because there's only a finite amount of time is what happened in the US with the production cuts, and you look at what happened with part of those drawdowns that we saw, the massive drawdowns that we saw kind of in recent times were from these huge production cuts in the US, which are returning. Like the production is kind of ticking back up. Exports have come back up, but exports have come back up at a time when we don't really need that crude. European refineries, and Eugene, I'm sure you can speak far better to this, but European refineries, it's kind of like make hay while the sun shines at the moment, with gasoline cracks where they are, even distillate cracks where they are. The flows from Europe to the US are staggering at the moment.
And that's having knock-on effects because you're pulling in gasoline from Asia, and it is But
those refineries will come back, and that crude is coming back. And okay, it generally takes longer. If you turn a refinery off from, people understand here, if you turn a refinery off from a power cut, that's not a pretty outcome generally. You add the big freeze in, and it takes time for this to come back, but it will come, and the production is coming. And so I think a lot of that neutral kind of picture has been helped by the fact that the US has kind of been taken out of the equation for a bit. And okay, you've had the ability to clear product from Europe, but that won't last, basically. And then what we're seeing from Iran is damned impressive at the moment as well.
Interesting note on, let's say, the AIS magic.
That was very interesting, because we talked to kind of the local players, and we had put in a note recently saying, well, what we're seeing coming from Oman is more than it should be. But we can go through and we can say, okay, those vessels, right, they weren't actually at the kind of the SPM as you would expect. But then it transpired with further conversations that no. The key was when one of the vessels appeared in a private marina off the coast of Muscat, and it's like, okay, that physically can't happen. That then leads you into working this out further, basically.
Interesting. Okay, good. A question to Eugene. So, on in your presentation on slide 18, you talk about refinery shutdowns. So both confirmed and probable. And a lot of that closed down capacity will, according to you guys, occur in Asia. Maybe you can sort of explain about that.
Yeah, I mean, there was the popular conception at the beginning was that if there's going to be refinery consolidation, it's going to be in Europe, for the simple reason that last time around it was in Europe. But in a way, that's also the reason why it's not going to be this time, because last time the weakest players were taken out, and those that survived, they already had a culling, and those that survived are a little bit stronger. That's one side of the story. The other side of the story is that the growth that we're seeing in refining capacity, that is highly slated to the east of Suez. So that's in China, that's in the Middle East, and also, next year, this year, there's still a lot of new refining capacity coming on stream. And as that comes on stream, especially in a low demand environment, you have a situation where, from a balance perspective, east of Asia is long in middle distillate. And right now, the pull on middle distillate from Europe, which is a region that's short, is far lower than it would normally be, which means that you have all of this new middle distillate coming on. Part of that is also IMO related, because a lot of people expected that IMO was going to radically increase demand for middle distillate, but it never did. And so as a result, you've got this massive overlength in balances, and yeah, that's where the competitive pressure is, and that is basically causing the older refineries in the region to shut down. And I mean, like Australia is a case in point. Several refineries shut down there, and basically turning into kind of a situation like we see with Latin America and the U.S., where you have a refining hub, and then you have cities attached to the spokes where they no longer produce their own, but they just import more.
Yeah. Any other countries that will most likely be hit other than Australia?
Yeah, I mean, we've seen the ones that have already shut down. I mean, the older capacity out there. I mean, there's been some in the Philippines, for instance. There's been some in Singapore as well. There's a lot of these refineries are very old, and this is the point. They used to be able to get by on a 70%, 60% utilization, but in the current environment, it's so cutthroat out there. Because you've got the efficient guys also that don't have so much demand. China doesn't have as much demand, so China's also exporting more product, and normally it doesn't. Normally it builds to primarily feed its local, and any excess that pops up ends up being exported. But right now those exports are quite high, so you have a situation where there's just a lot of competitive pressure. It's difficult to get the ARB to work to Europe, and with car sales and the situation in Europe also becoming cleaner, the pull on middle distillate is also shrinking, and will continue to shrink. So that's something where if you look, is the situation going to get better in 2 or 3 years? And then if you look at the actual balances, we actually see Europe becoming long in middle distillate in the 2030s, in the early 2030s, which is of course a terrible news for any region that's also long in middle distillate. Yeah.
Yeah. Okay. Well, thanks, Alex. Anything to add to this, or?
No, I think the one change closer to home that's really going to hit this year is Jizan in the Red Sea, and that's going to a big refinery, big distillate producer, big gasoline producer. It's really going to change that Red Sea short. It can basically take out the whole distillate short. On its own.
And what that does is it means that like India that used to be supplying that. So if we look at East Africa, if we look at even a bit to the Med, that all goes away, which means India ends up shifting more of its export-oriented molecules into the Asian market that's already long. And so, yeah, that's where the competitive pressure comes from.
Yep.
But from a terminal perspective, I mean, I would like to say there is, it's not all bad news in the sense that when you shut down these refineries, you're not shutting them down and putting apartment complexes there. You're shutting them down and converting it into an import terminal. You need the storage space. You're going to remodel the tanks a little bit, and so you will actually have an opportunity there. For shipping, it's great for clean product shippers. There's opportunity in every challenge.
That's definitely the case. Okay, yeah, you're right. So what's bad for the refining sector isn't necessarily bad for terminal business or trading whatsoever.
Yeah.
Okay, good. Thank you. Another question to Alex. What will be the main factors behind the continued stock draws through the rest of the year?
I think it's kind of pretty related to what we've discussed already in terms of excuse me. Can OPEC Plus maintain discipline and the speed with which demand recovers? Essentially, it's the two factors, and I think my current take is that they're both kind of to the skew is to the bear side, and it's probably going to be creeping higher production and creeping lower demand. You look at the IEA, every single IEA report that's come out, they've revised lower their demand forecast for the last 6 or 7 months, I guess. Things continue to surprise to the downside. At some point it will turn. I think there's a lot of discussion that and projection in the US that it will absolutely fly this year. But that's great for the US, but that isn't the case for Europe. I don't see that happening. I think the rest of the world could run away from us, essentially, which from a global demand point of view isn't fantastic.
Yeah, well, you guys are at least on your island.
Well, we can't do anything though.
I mean, the situation. I mean, we're also starting to reckon with the third wave lockdowns in several European capitals, because the numbers are atrocious. And if we're slowing down on the vaccine front, the only logical conclusion is that to save lives, we're going to have to lock down again, and that's going to bring us to where we were in a couple months ago again.
Yep.
We're getting so tired.
The sigh of resignation.
Stock Expo 2022 online.
Oh my god. Okay. Another question. Let's try to keep the spirit, right? Another question to Eugene. So in your conclusion, you mentioned that shipping efficiency regulations will hit VLSFO more than HSFO. Why is that?
Yeah. Okay. So I mean, there's the big deal right now in the shipping industry is basically getting to zero emissions. And for a while, this looked like it was there's a 2030, which is a design index, not a big deal, easy to meet. Then there's a 2050, which is difficult to meet. But now at the upcoming MEPC meeting, the IMO meeting, the next one, they're going to pass, at least it seems very likely that they're going to pass something called the EEXI, so the Energy Efficiency Design Index on existing ships. And that means that older ships out there will have to somehow become cleaner. And so there's a few options you have available if you're an older ship. I mean, you can invest a lot of money and put in a new engine, but if the ship is already 15 years old, you're probably not going to do that, which means you can, send it to the bulkers in Bangladesh and sell it for scrap metal, in which case then that consumption dies and gets replaced by the new vessels, which are much more efficient. So that would mean that, the other option you might have for the old vessels is simply to run to basically like you do with trucks on the roads, that you basically cap the speed level. So if you're only going at 12 knots, you're going to consume and emit a lot less CO2 than if you're going at 15 or 16 knots. And the problem is that the older tonnage, because it's old and people expect it to exit the market soon, people didn't spend $1 million retrofitting that. In many cases, you couldn't even do that because the engine space is too small. So it means that this is where the demand is, because an old VLCC can have a demand easily of 80 tons of fuel oil per day that it's burning. The newer super eco VLCCs coming online, they have 40 tons of fuel oil consumption a day. So that's already massive. And these guys that have 40 tons are taking HSFO, and the guys that have 80 tons are taking VLSFO because they have no other option. And that means that if this 80 turns into 60 because you're driving slower, or if it gets replaced by a 40er because you've demolished the tonnage, then come 2023 you have a big shift, and that's something that I think will be tremendously exciting to watch. And yeah, I think 2023 is going to be another big year in terms of shipping and also in terms of oil products.
Okay, interesting. We'll put that into my calendar. Okay, so let's look at some questions from the audience. So this is an interesting one for the terminal business. So in the past, we saw a lot of arbitrage of fuel oil, and this one is, I guess, for Eugene, of fuel oil coming from Russia being put into terminals and then reloaded on VLCCs that sort of discharge their crude oil in Rotterdam, fill it up with fuel oil, and then sailing to Singapore. That totally disappeared, and now we see a lot of fuel oil going straight from the Baltics to the US for coker feeds or whatever. Is that going to change or not? Or
Yeah,
because a lot of terminals would like that to change, obviously. But
I can give you the conceptual answer, but Alex will have the real answer, because what they're doing is they're actually, tracking the actual cargoes. So
okay, sure.
We actually use Kepler as well, and we're very happy with it. But conceptually, what we're seeing is that. I mean, you had a situation where, as you were saying, Patrick, you were sending a lot of this HSFO to Asia. Now that is over. Asia wants and needs VLSFO from the Atlantic Basin, but it doesn't need much HSFO. In the summer, there's spikes in the Middle East, and that's where you'll get some Egyptian fuel oil cargoes. You'll get some, even some LSFO cargoes occasionally from Italy or from the Med. And if the demand is really high, and if crude intake is particularly low or something, you might take the odd ARA cargo over into the Middle East. But into Singapore, I would say that to make the ARB work, because you're not going to take a 2 million barrel VLCC into Singapore anymore, because nobody needs those volumes of HSFO anymore, which means it's going to be a smaller cargo. And if it's a smaller cargo, it's a more expensive cargo. So to get the ARB to work, you need the regional disparity in price to offset the freight. But the freight is quite high because it's a smaller cargo. And so if the spread would widen enough to be able to take that cargo from ARA all the way to Singapore, it would be most likely a very interesting feedstock on the US Gulf Coast side. So before it makes that trip, it would get snapped up by refiners on the US Gulf.
Okay, yeah. I think recently, maybe 2 or 3 weeks ago, we saw actually a VLCC going to Singapore, or well.
The question is how laden was it? It might have been a backhaul type thing where it came over from the Middle East carrying crude, dumped the crude off, and then didn't really know what to do, and partially loaded with a bit of fuel oil. So I don't know if it was fully laden or not, but
yeah. Maybe Alex can answer that one.
Yeah, so I'm trying to find. We literally a week or so ago we put a story out looking at the change in floating storage in Singapore, and I think it was with the and it was around, as you say, the high five, the shift in the high five, and the swing back into ultra low floating storage, basically, against high sulfur. And yeah, how that's kind of reversed again, basically. But yeah,
so
can't
basically
find the story.
more of a storage dynamic than an actual demand dynamic.
Yeah. And let's say we just coming through into the floating storage. I mean, that's one of our kind of highest in demand kind of data pieces, is what's floating off, what fuel oil is floating off Singapore, and trying to work out whether it's on spec or high sulfur, essentially. That's a fun task, given all of the blending operations and so on out there.
But on the VLSFO side, I mean, those flows have gotten quite interesting, because you have all kinds of new players. I mean, you've got Brazil sending to Singapore. You've got Russia that's become really adept and really capable of sending low sulfur fuel oil. So basically low sulfur fuel oil components, or VLSFO itself. Probably it still has to be blended when it lands in Singapore. But it's become a big supplier also of low sulfur fuel oil molecules.
Okay, well, thanks. So I have a question myself. So these, for instance, Kepler system has in some way, and I guess more of these advanced analytics and monitoring system have been blamed for the very short contango recently. Because OPEC could very accurately determine, okay, well, how much is the oversupply, and how much do we need to cut? What's your sort of comment on
that? I think so. Our general approach and the overall ethos is to bring the transparency that previously was only available to a very small number of market participants to as many as possible. So in as much as OPEC members can look to see kind of what we're saying, that's also available to to the rest of the market. If we think of the response in price action to the outcome of the last OPEC meeting, everyone was expecting cuts to be eased and so on. Personally, I was, you can always say this, Harry hindsight, I wasn't surprised that they rolled it over, because you look at the inventories, you look at the exports, it wasn't a surprise, to be honest. The question was, Saudis were going to push for it, how much could they persuade other people that it was the right thing to do? And the fact is, you could see in the data that inventories stopped drawing. They were building in China. Flows were increasing from the key players, and you can just say, right, well, the US did its thing because of the severe weather, but it was going to come back. So yeah, I mean, I don't think it was a surprise, and the information is available to anyone that wants to look at it. And I think that's the key thing. It's that kind of democratization of information on a much broader scale that means that we shouldn't have these surprises. Ultimately, OPEC is a guessing game, like depending on what they're going to do. And I'm sure Eugene well knows, you around the corner from I'm sure you've been to more kind of OPEC meetings than anyone would care to want to.
That doesn't help too much.
But,
they should do the microphones or something like that.
Yeah.
But on that subject, I would actually say that it's been very good and very astute market management from OPEC that's stymied the contango.
Definitely.
The fact that I mean, who thought that they would have, done that they would manage to cut that much, that they would get the Russians on board, that everybody got together and cut to such an extent. Even if it were 1 million barrels per day less of a cut, or if somebody would have cheated a little bit earlier, everything would have changed. But I would say that it's not the data metrics, because when that deal was getting done, in the heat of the moment, you were going from, as Alex was saying, you were going from April, where there was actually tremendously amount of crude in there, and people knew that there was a big problem. And then you had the massive OPEC response combined with that US response. And the US response was not voluntary, it was price driven. They had to go off. And in fact, it wasn't just the US, we were monitoring other countries as well. And even, places like Nigeria were also shutting in production. So there was just this massive shut-in in production, and combined with that OPEC that kept the volumes off. And then, I would agree that then, you can monitor much better than you could in the past. So it helps once the agreement's in place. You have these monthly JMMC meetings, and those obviously, they require this data to look and make a more informed decision. But the political will has to be there, because if OPEC doesn't cut, and then,
Yeah, just sort of memorizing past OPEC decisions, maybe 10 years ago. Everybody would say, yeah, well, they're saying, they're going to cut, but the reality will be something different. So now they can actually monitor everything.
Well, I see where you're coming from, but with Iran, at least up until recently, out of the game, and with Venezuela out of the game, those were the hawks and the guys that, at least historically, might have been the ones that would, the usual suspects, shall we say, along with, Nigeria and a few others, the ones that, historically had tended to play fast and easy with those. But with some of them out of the game because of sanctions and closely monitored, yeah, that's, but yeah.
It's harder.
Good. Yeah, definitely. Okay. Let's see if we have some other questions. Yeah, I think we were done actually. Margaret is appearing. Hello, Margaret. Are we out of time?
We're actually out of time.
Oh, okay.
So if you want to just wrap up and give a quick summary, and then I'll do some concluding remarks. Thank you.
Sure. Okay. Thank you. Okay, well, as I said, I guess from the beginning, when we began with this late afternoon session, we definitely, have the best for last. So I think it was a really interesting, 3 presentations, cool robotics, and good market insight from both JBC and Kepler. So thank you very much. And hopefully everybody enjoyed the conference. Personally, I like a live one better, but we just have to live with it right now. So thanks again for this opportunity, and hope to see you soon.
Yes, thank you, Patrick. I agree. Yeah, really, really dynamic sessions in the afternoon. So thank you. That does bring us to the end of the Terminal Tomorrow conference. So yeah, thank you to all our speakers and to our sponsors as well. And yeah, we very much hope to see you live in person soon. And we'll be in Rotterdam for next Stock Expo in March. So thanks again, and see you all soon.
Thank you.
Thank you so much.